Dear students and viewers, I hope you all are pursuing the goals of your lives. I've introduced this segment on my channel to regularly upload videos based on exam style questions about accounting, finance, economics, and business mathematics. Based on my teaching experience spanning over more than 3 decades, I believe that this approach of learning is the best for both beginners and advanced level students. So please subscribe to my channel and click the bell icon to stay informed about new videos. These videos will help you understand important concepts in a friendly manner to pass your exams and apply these concepts in real life. This is the first video in the series, and today's question relates to the subject of financial accounting. The question is, which one of the following bookkeeping errors does not affect the view given by the financial statements? Four options are given. These include A, an error of principle; B, an error of omission; C, an error of original entry; D, an error of omission. Well, to find the correct answer, we need to understand the four types of errors mentioned in this question. So let's quickly understand the nature of these errors. First, we look at the error of principle. The error of principle means recording the transaction violating the accounting policies and procedures. For example, treating the purchase of an asset as an expense. This is an error of principle. A practical example will be where an organization buys new furniture for $5,000 for cash. However, the bookkeeper records this transaction by debiting the expense account instead of the furniture account. This error will affect the financial statements because the balance sheet will show a lower value of assets because purchase of furniture is not recorded as an asset transaction, while the income statement will show a higher value of expense because the asset purchase is recorded as a business expense. Now, what is an error of omission? This type of error happens when you forget to enter a transaction in the books. You may forget to enter an invoice you have paid or the sale of a service. For example, a business buys supplies for $1,000 by making cash payment but forgets to enter the purchase in the books. Since the purchase of the supply expense has not been recorded, therefore the income statement will show less business expenses by $1,000, while the balance sheet will show a higher value of cash by $1,000. Similarly, if a business forgets to record a payment of, say, $500 that it has made towards accounts payable, this error of omission will also affect the view presented by the financial statements because neither the accounts payable has been reduced by $500 nor the cash balance has been reduced by $500. This error will result in showing a higher value of accounts payable by $500 and a higher value of cash also by $500 in the balance sheet. Now let's look at an error of the original entry. This error occurs when an incorrect figure is posted to the relevant account. A perfect example is a transposition error where the figures aren't recorded in the right order. For example, instead of recording a business expense as $2,500, it is mistakenly recorded as $5,200. This will result in increasing business expenses by $2,700. The difference between the correct amount of $2,500 and incorrect amount of $5,200. So this type of error will affect the financial statements because the wrong amount has been recorded in the ledger accounts. Finally, the error of commission is an error that occurs when a bookkeeper or accountant records a debit or credit to the correct account but to the wrong subsidiary account or ledger. For example, $250 of money that has been received from customer X is credited properly to the accounts receivable account, but to the wrong customer ledger account, say against customer Y. Logically speaking, this type of error will not affect the position shown by the financial statements because the accounts receivable as well as the cash accounts have been properly debited and credited with the amount received. Although the individual accounts of the customers X and Y contain this error. So this error will affect the individual accounts of those customers, but not the financial statements. That is the income statement and balance sheet. So now you can say with confidence that the correct answer is option B. That is, an error of commission will not affect the position shown by the financial statements. If you have enjoyed this video, please do subscribe to my channel. Click the bell icon for notifications and also share and like this video. Thank you for watching.